If you're thinking about buying a business, you've probably heard of sellers talk about unreported cash. They might say, hey, look, the business is making way more money than the actual tax returns show. It sounds tempting to believe them, right? But before you fall into this trap, I'm going to show you why the tax returns should be your best friend when buying a business and how to avoid getting played by sellers trying to pull a fast one. In this video, we'll cover everything you need to know about using tax returns to ensure you're making a smart investment. Let's dive in. Let's start by debunking a common myth. Profit and loss statements, or P&Ls. Sure, they sound like they're pretty straightforward on paper, but they're not quite as accurate as the tax returns. Profit and loss statements can easily be manipulated. Sellers can twist numbers and make them look better than what actually is happening. They lack consistency. Each one can be unique as a snowflake, making comparisons nearly impossible between businesses. And many small business owners don't even know what GAAP is, let alone follow it. By the way, that's generally accepted accounting principles. Instead, they might use their own creative accounting methods. That's why relying on profit and loss statements alone can be like trusting a friend who says they're going to the gym, but they never seem to lose weight. Always double check. Now, let's talk about tax returns. They are the most reliable document when assessing a business. If the seller tells you, oh, the tax returns don't really show the true income, that's a red flag. Unlike profit and loss statements, tax returns do follow a standardized format. They're much harder to manipulate. Banks use the tax returns in determining the debt service coverage ratio, or the DSCR, to see if the business can pay back the loan. There's a reason banks use the tax returns rather than the profit and loss statement. Think about your tax returns, or think about the business's tax returns as a safeguard. If the business isn't making money according to the tax returns, chances are it's either not making money at all or you're dealing with a seller who's not honest. Imagine this scenario. You're sitting with a seller and they start bragging about how much they've been skimming off the top for years. They think they're smart. But all this means is they've been cheating Uncle Sam. And guess what? If the IRS doesn't know about it, neither should you. Here's what you should say. It looks like you've already had the benefit by avoiding taxes. I'm here to buy the business, not a fantasy. So let's stick with what's on the tax returns. Watch the seller's face as they realize their little game isn't going to work on you. They can't get the benefits of not paying taxes and double the valuation, what they never paid taxes on to begin with. Why banks trust tax returns, and you should too. So let's talk about the banks. They don't care about creative accounting or unreported cash. When banks are deciding whether to give you a loan, they rely on the tax returns to calculate something called debt service coverage ratio, or DSCR. The DSCR shows whether the business can pay off its debts. The higher this ratio, the better. And it's all calculated using the tax returns, not some made-up profit and loss statement. So if the bank doesn't trust the profit and loss statements or the unreported income, probably a sign you shouldn't either. So how can you make sure you're not getting played? First, look at multiple years of tax returns. Review at least 3 to 5 years to spot trends. Did the business have just one good, lucky year, or is there real growth? Second, cross-check it with profit and loss statements. Profit and loss statements can still be helpful, but they're used to verify against the tax returns. That's a big discrepancy. And if there's a big discrepancy, it's a red flag that you then need to go back and rely on the tax returns. And finally, number 3, hire a CPA or a financial due diligence expert. A professional can help you comb through the tax returns versus the profit and loss statements, possibly reconcile the two of them and see where there's discrepancies that can help you from making a mistake. When in doubt, trust the IRS, not the seller. At the end of the day, tax returns are your best defense against buying into a fantasy. Sure, the seller might have pulled one over on the IRS, but don't let them fool you. Stick to the tax returns. You'll most likely be able to make a solid investment based on those. And remember, if a seller can lie to the IRS for years, can they really be trusted? Why aren't they going to lie to you in just meeting you for a day or two? Unreported cash is not only illegal, but it's a sign that the seller lacks integrity, so don't fall into their trap. Now, if you're considering selling your business, hopefully you have all of your income on the tax returns. That's how you're going to get the best valuation. Reach out to me. I'll walk you through the process of how to determine how much your business is worth based on the tax returns, and we can get the business pre-approved with the SBA and take it to market to find a buyer for you. And the best part is, you never have to pay me anything up front. I only get paid if and when I sell your business. So there's no risk to you and there's no obligation. So use the link in the description and let's set up a time to talk. We can find out how much I can help you sell your business for. Thanks.